Hi, I'm Professor Bei Dong from USF School of Accountancy. Today, we're going to cover many topics related with balance sheet and statement cash flows. In this video, we're going to talk about how to use ratios to analyze profitability of a firm. Generally speaking, profitability ratios are designed to measure firms' earnings power, and we're going to use them to assess performance of a firm as a percentage of some levels of activity or investment. First of all, let's talk about ROA, return on assets. It equals net income plus after-tax interest expenses divided by average total assets. The numerator is the total return this company can generate for all the investors of this company, including their owners and the creditors. Net income is considered as the return to the owners, while the interest expenses is considered as return to the creditors. The denominator is the average total assets, which is the total economic resources this company has. Average means last year plus this year divided by 2. So this ratio measures the total effectiveness at managing capital provided by all the investors, including stockholders and creditors. Since this ratio measures the total return this company can generate for every $1 of their average total asset, we want this ratio to be as high as possible. The second ratio we're going to talk about is this return on equity, ROE. It equals net income divided by average shareholders' equity. The numerator is the net income. Denominator is the average shareholders' equity, which equals last year plus this year's shareholders' equity divided by 2. This ratio measures mathematically how much net income this company could generate for every $1 of shareholders' equity. So this ratio measures the effectiveness of this firm at managing capital provided by the shareholders. This ratio directly talks to the shareholders or the owners. If you remember, when we talk about the ROA, that ratio talks to all the investors, including shareholders and the creditors. And similarly, we want this ratio to be as high as possible. When we analyze ROE, we'd like to partition this ROE into 3 parts. ROE equals return on sales times asset turnover times financial leverage. Return on sales is calculated as net income divided by sales revenue. This ratio measures how much net income this company can generate from every $1 of sales revenue. We want this ratio to be high. The second part is this asset turnover. It equals sales revenue divided by total asset, and this one measures how much sales revenue can be generated from every $1 of total asset. So this one measures the efficiency of this particular firm's generate sales revenue from the assets. And third one, financial leverage, is really the capital structure of this firm. So when we analyze ROE using this little model, we're trying to understand what are those factors driving the changes in this ROE. So this little ROE model also can tell managers that there are 4 ways you could do to improve your ROE. Improve return on sales, improve asset turnover, improve use of financial leverage, or some combination of 1, 2, and 3. The third profitability ratio we're going to talk about today is this gross profit margin. It equals sales minus cost of goods sold, which is also called gross profit, divided by sales. So this one measures for every $1 of sales revenue, how much gross profit can be squeezed out of it. So as a manager, if you look at this ratio, if you want to increase your gross profit margin, you need to increase your revenue while at the same time control your costs. Now, let's do a little bit analyze over here using the gross profit margin. This is this company called Cisco. From 2003 to 2005, you can see that sales revenue increase. Cost of goods sold increase. Gross profit in terms of the raw value increase also. However, our gross profit margin decrease. I use red color to let you know that this is a decrease. How come? this is a little bit inconsistent. How could this gross profit in terms of raw numbers increase while gross profit margin in terms of the percentage, in terms of ratio, decrease? What is the story over here? How could we explain this inconsistency? There's a simple answer over here. Although for this particular company, the sales revenue increased over these 3 years, the cost of goods sold also increased. And besides that, the cost of goods sold increased faster than the product sales revenue. So for every $1 sales revenue, they actually squeeze less of the gross profit margin over those years. That actually causes our gross profit margin decreases. There are 4 possible reasons for a decline in gross profit margin ratio. For example, your product line is old. That's going to negatively affect your quality of your product, the efficiency of your operation. Secondly, there's new competitors coming in to the market. They bring new technology. They bring new product, better product that actually grab your market share, negatively affect your revenue. Thirdly, general decline in the economic activity. When there's an economic depression, market demand decreases. It makes you more difficult for you to generate sales revenue. Fourthly, manufacturing costs have increased, so it makes you more difficult to control your cost, decrease your gross profit margin.